So the VIX, which is a measure of put and call option ratio against the S&P 500, spiked over the last week. Unless you've been living under a rock, you might have felt a little edgy, wondering what the hell is happening around the stock market. Well, the short version is that people were expecting the US Congress to pass some version or one version of the 1.9 trillion stimulus bill, which will potentially cause a spike in inflation. And when inflation runs really hot, the Federal Reserve might jump in, raise the interest rate in order to tame it.
Yeah, okay, cool story, bro. But how does that impact the stock market?
Without overcomplicating things, higher interest rates, especially on long-term government bonds, will tend to push the valuation of your growth stocks down. That's why before Uncle Powell makes his semi-annual appearance on Capitol Hill, there was expectation that he might push interest rates up earlier to tame inflation, contributing to the broader market sell-off. As of recording this video, the Nasdaq Composite Index declined about 3% over the last week, which is a pretty big move for an index. And generally, our market followed the US market, dropping about 1% over the last week. But because our index is not very heavily weighted towards tech, we're not as badly impacted. Now in this video, I wanted to check in with you to see how you're doing, and also give you an update on the things I've done for myself and finish explaining one of the new additions in my portfolio. So how are you personally feeling? Talk to me in the comment section below. Me personally, I feel pretty energized but a little bit nervous. Energized because it's about damn time. And during these turbulent times, I find my learning curve for the markets and human emotion really steep. It sounds a bit crazy, but sleeping feels a little bit like a chore at the moment. I can't really wait for the Aussie or the US market to open. And I have a little bit of nerves because, like many of you, this is like my second time that I am consciously aware when something this turbulent is happening right in front of me. Okay, that's enough about feelings. There are a couple practical things I want to share with you before I get into the new addition in my portfolio. But let me get the boring stuff out of the way. No, I'm not a professional. I'm just a random Asian dude you found on the internet. So nothing in this video is financial advice or recommendation for you to do anything. It's just general information for entertainment purposes. Let's talk about a few things I've learned as the market was correcting. Firstly, it pays a lot of dividends to have your preparation done beforehand. I've talked about this pretty extensively in my 3 steps I took for myself to survive the next market correction video. And being prepared, especially when it comes to your portfolio, I'm referring to you understand the business on your watch list really well, you understand the growth rates, you understand the financials, and you understand the team. And most importantly, you understand the appropriate range you're willing to pay for that company. Because the thing is, you can get the market, the business, and the team right. But if you get the price wrong, it will completely change your risk to reward profile. Now, as the market was correcting, I found out because I've done my homework, I knew what I had to execute on. So I wasn't that emotional. But still, I'm only human. It's hard to not feel any kind of emotion. So instead of saying, oh, don't get emotional, I find ways to manage my emotional state. And sometimes it's easy to say, oh, don't get emotional. That's like asking your partner, especially if they're mad at you, and you say to them,
hey, don't be mad at me.
What do you think is going to happen? They'll probably get more mad. The point I'm trying to get at is that the deeper your preparation, the better you'll be able to manage your emotional state. Another way I found to manage my own emotional state, especially during these very turbulent times, is to increase my income level. Yep, I took on a bit of extra client work so that I can generate more cash flow in order to invest more. And having more disposable income makes me feel a lot easier knowing I don't need the money. And lastly, don't get too caught up on social. There's going to be a lot of commentary as the market goes really crazy, and going on social will only impact your emotional state. So those are the learnings and the things I've done for myself so far. I'll give you another update in my next video. And as promised, let me explain why I added Porch Group into my portfolio. Now, as of recording this video, Porch Group is trading at $19 per share at 1.55 billion market capitalization. Again, I just want to remind you that this is just my own reasoning for going down a particular path. It's not a recommendation or financial advice for you to do anything. And for a balanced view, I'll provide a bull case and a bear case. First, let's talk about the product and how it generates revenue. Porch is a vertically integrated SaaS business to home inspection, moving, or insurance service businesses. That long sentence just basically means that they provide software for home inspection or moving companies to manage their customers, their contractors, or even help generating leads for the business. What's really interesting is that Porsche's customers that's using the software is providing a lot of data points on home buyers, giving Porsche the unfair advantage to know if someone might be moving before everyone else knows. They also claim that nearly 2/3 of US home buyers flow through Porsche's software platform, not to mention 26% of all US home inspections are managed through Porsche's inspection software. Now, I like to take those statistics with a grain of salt, but damn, that's pretty impressive. Now, because Porsche have access to these customers and they know that these home buyers are moving before everyone else does, they can actually provide a comparison service by partnering with service companies to essentially help consumers decide on their security system or their TV or internet connection. And on top of that, generate a transaction value by helping consumers with their purchases. This kind of software, data, and customer flow advantage, to me, just seems like a straight up cheat code. Porsche is already growing really quickly on its own, with their core business growing at 66% year on year. But beyond that, ever since Porsche went public, they've acquired 4 adjacent companies to help grow the business even faster in the future. And the acquisitions will add about 50 million to their 2021 financial year, resulting in a 134% year-on-year growth for Porsche. The question is, can they continuously grow at this fast pace? The truth is, I don't know. But I'm going to manage my own expectation and pretend they're not going to double their revenue again in 2022. But I do know that they have 2 core growth levers that they can pull to grow even faster. For example, companies using Porsche's software can either pay a subscription fee or they could actually pay by allowing Porsche to access their customer base. And another growth lever is that Porsche is only capturing about 1% of the total value opportunity per home buyer. So there is a lot of opportunity to expand on the customer lifetime value. And with their new adjacent acquisitions, they have significantly expanded their total addressable market from 228 billion to 320 billion, giving Porsche a lot of runway to increase their revenue down the track. Okay, so the business model, the software, and the stats sounds really good. But the next question is, what is the probability of Porsche being able to bring this story alive? Well, that's a question of execution risk, right? Now, feel free to dig through the exec bios yourself, but this is a co-founder-led, very loaded both marketing and product team. And I really think the talent speaks for itself because it translated into pretty amazing financials. So let me summarize. The bull case for Porsche is that they have a clear unfair advantage in its business model where the software they provide are enabling them to accumulate data points and early access to home buyers before everyone else knows. That kind of advantage over home buyer customer flow will ultimately create a switching cost so high that some of these moving companies or home inspection companies just won't want to move off the Porsche platform in order to access that home buyer customer flow. And together with the loaded management team that have translated into a 66% growth in their core business and 130% growth year on year, taking into account their adjacent acquisitions. But the bear case is that I'm worried whether they can actually successfully integrate these adjacent companies into the group, not to mention the increased scrutiny around data privacy. And lastly, I'm just worried whether the founder can actually help the public understand the business so that the public can actually reward Porsche with more of a high growth company multiple. Now, as it stands, the bull case trumps the bear case. And at an enterprise value to 2021 revenue at 10 times, I personally think I am early to Porsche's multiple expansion over the years, but I could be wrong, so we'll see. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.